Well, welcome everyone to our YouTube live session, and it's the usual story. We've got an hour together, and there are certain people who will get priority in terms of the answering of questions, and those are the people who have supported us on YouTube. So if you're one of our YouTube supporters, then you'll get pushed to the front of the queue. Laura will shout out if you ask a question, and she'll put them on Slack so I can see it. And if you go for a super chat, which you have to pay for, then I'll also push you to the front of the queue. And then I'll work through the other questions according to that priority list. So that's the plan. We have an hour. Let me just kind of briefly talk about what's been going on in markets. There really hasn't been a very interesting move in any market at the moment, other than crypto selling off a bit more. So my Ethereum is worth even less than it was last week or 2 weeks ago since the last YouTube live. But, you know, crypto sells off. Perhaps it's because of the clampdowns in China on mining. Who knows? And in the equity market, really not very large moves either way. News about the infrastructure deal in the US being scaled down somewhat, which is kind of interesting. That will certainly have a market impact, although that'll be fairly delayed. And the video I did for supporters on Patreon this week, who are kind of like our PensionCraft family, I've got a very capable intern who's working with us called Patrick Haddow, who may be listening right now, so I have to be careful what I say. But Patrick and he created an explainer this week for the first time, which is very brave of him. And this was going back through periods of high volatility. In fact, he used a book I wrote in the past to kind of give him some ideas, which was called Invest in Fear. And there I try to extend the VIX index back before 1990, because that's when it was started, by adding 4% to realize volatility. And that let me push it all the way back to 1960. So I could look at the volatility of the S&P 500, and add 4%, and that quite closely matches VIX. And then you can go back and look at these high volatility episodes and try to explain what caused them, and then see if they have any kind of bearing on the markets that we see today. And there are all sorts of causes of volatility. You know, it could be war. War's a common one. Sometimes war reduces volatility, as happened in the case of Kuwait. But then sometimes war increases volatility. And then you have political events like the Kennedy assassination, the resignation of Nixon. And then you have things like stock market bubbles popping, or large defaults of big companies like WorldCom and Enron. Or you could have volatility for no reason at all. People just get scared, and that's called a flash crash. That happened in 1962, 1987, and in 2010. So I think you know, there are loads of reasons why volatility happens, but I think the really interesting story is that most of the time things are okay, and you can just completely ignore the volatility, invest, and just leave it for a long period of time in equity, and it just goes up. So that's the nice thing, which is that all of this scary stuff happens, which is very mentally stimulating, in the sense that people like things which are newsworthy and shocking, but the boring truth is that you can just ignore all that stuff and just invest for a long period of time and don't even look at your investments, and you'll probably be okay. So that's the kind of story. But anyway, if you want the full video, I think Patrick and I were riffing off each other quite well. Bit of a difference from the usual explainer videos which we do, which is just me. But if you want access to that, you have to support us on Patreon. So go to patreon.com/pensioncraft. There will be a link that comes up in the video, but also in the description. So if you want to do that, you can. But for tonight, the stars of the show will be the people who support us on YouTube, because they get their questions answered first. So after that quite lengthy introduction, let me start on the questions. So we don't have any questions from supporters, so I'll go to the questions from other people. So, Chestad, nice to see you again. Who says, oh, Alex says, hola amigos. Hi friends, hi Alex. Chestad says, ready for the global economy update. Looks like USA will get an infrastructure bill passed. Yes, passed but shrunk slightly, which is good. Maria, DC, says that she's moved her work pension to a SIP with Hargreaves Lansdown and got the funds as cash yesterday. Any insight re when to invest? I'm 45 years old, but worried about inflated prices, tech bubble, etc. So maybe wait for a bit. Any view? So the difficulty with holding money back, Maria, is on average, equity markets go up 6% per year. That's the base rate. If you don't know anything else about valuation or political crises around the corner or anything else, if you just shut your eyes and guessed, the most likely rise in the S&P would be about 6%. Maybe a bit more, maybe about 7-8%. But that's the kind of average amount by which the S&P goes up. So if you hold your money back from the market in cash, which is earning almost zero interest at the moment, then you'll miss out on average by 6% or 7% every year. If you factor in the fact that currently in the US valuations are very high, that slightly increases the probability of a fall in the markets. I did a whole video about it, but the actual probability of a fall by say 30% in 1 year is still very low. It's higher than it would be if valuations were low, but it's still not very high. I think it's around 4%, 5%, something like that, if valuations are very high in the 75th percentile. But the take-home message of that video and the analysis I did was, even if valuations are high, it's not worth holding back your money. It's usually best carry on drip feeding your money in. If you've got a lump sum, you can always split it into chunks. That's what I'm doing at the moment. I've split it into 24 chunks, and I'm 4 chunks in now. I put 4 installments of my final equity allocation into the market. And if there is a crash in the equity market, I'll accelerate my equity purchases. But if there isn't, then at the end of 2 years, I'm going to be fully invested, which for me would be 80% equity. So that's the other alternative. If you are scared about a market crash, then perhaps drip feed. Or if you're scared of a crash, maybe you shouldn't be putting so much into equity, because what you've got to find is an asset allocation that you can sleep with, where you're not going to be worried about market crashes. And if the equity market falls by 50%, you're not going to feel depressed you're not going to feel good, and nobody's going to feel good if that happens, but you won't be devastated, put it that way, or economically impacted such that your quality of life dramatically gets worse. So let's say that you put 50% in equity, 50% in bonds, short duration bonds, then in that case you would only take half of the hit if equity markets fall 50%. So you'd only lose 25. So maybe that's the way to do it. Either reduce your asset allocation in equity such that if there is a 50% crash, you'd be happy with it, or have a higher equity allocation, but maybe drip feed it into that final allocation gradually. Because then if there is a crash, which is what you're worried about, I guess, you can always buy more. Because remember, when equity markets fall, that's when you buy a lot. That's the way equity markets work. So just get used to the idea that you will at some point take these 50% falls, because that's just a feature of the equity market. It's an opportunity to buy more. And, that's good for everyone, really, if you have money to invest. Okay, next question. I hope that answered your question, Maria. Also, Maria has a follow-up question. Views on Michael Burry's prediction of a massive crash. Well, he doesn't know. I don't know. And if he says he does know, he's lying and he's a fool, because nobody can predict these things. But maybe there will be a crash, but if you have people that always predict a crash, eventually they're going to be right. He also predicted that ETFs would cause a massive problem for equity markets. Another prediction that was kind of hugely untrue. So, I don't really buy into anyone's ability to predict markets, particularly over a 1 year period or less. Over 10 years or more, any fool can predict, on average, equity markets go up. So I think, if you're going to forecast for 50 years. Don't forecast for a year, because it just makes you look like a fool, because nobody can forecast accurately.
Slack.
There's a question on Slack. Two questions on Slack. So I'll switch to Slack. And Lenin Velaturi, nice to hear from you again. Thank you for supporting us, Lenin. What do you think of index investing bubble? Well, the thing is, everybody talks about this index investing bubble, but the fact is that whether you have a mutual fund which is actively managed, which is benchmarked against an index, say the S&P 500, or whether you have a passive fund which just buys the index, the fact is their actual allocation in terms of stocks will be very similar. The reason for that is that if you have something like an S&P 500 benchmark for most mutual funds in America, say, what they'll do is they'll take the benchmark and they'll slightly increase the weights for the stocks which they think will outperform, and they'll underweight the allocation for stocks which they think will underperform. So overweight the things which they think are good, underweight the things which they think are bad, and if they're right, they'll generate alpha. They'll outperform the S&P. But the size of those deviations is often very small, because a lot of funds track the benchmark quite closely. And if that's the case, then billions of dollars in America are already indexed, and they have been for decades, many decades, long before we had anything like ETFs, for example. Even before the 1970s, we had benchmarked funds. So I think if that's the case, then there's no bubble, because in the past, money was indexed against indices as well. So I don't buy the argument that there's an index bubble. If lots of people invest in passive funds, again, I don't think that's a problem unless everybody invested in passive funds. And that's far from being the case. I think it's roughly 50-50 at the moment for the US, for example, in terms of passive management, where they just buy an index, and active management. So, I don't really think, unless it's a very illiquid market, like high yield credit or volatility ETFs, ETNs usually, then in that market, you can get a distortion of the market if lots of money floods in via these passive funds. But in a large market, a large liquid market, any developed market equity index pretty much, or most emerging market indices as well for equity tend to be very liquid. So I don't think the ETFs are going to distort that market. And probably we could get to 90% passive, 10% active, and still get good price discovery. It doesn't take many arbitrageurs to be out there in order to push prices to their correct level. At least that's my belief. So index bubble, I don't really believe in one. Next question is from Stephen J. Thank you for supporting us, Stephen, who says, would you recommend investing in an energy sector ETF dominated by oil companies? Do you think there's any future there investment-wise, since there is a green bubble with ESG ETF funds? So if you go for an ESG fund, probably, not always, they try to keep away from energy as one of their criteria. Although they do sometimes buy energy companies too. So I think the difficulty with energy ETFs, oil companies, buying oil companies at the moment, is they're undergoing this kind of transformation from fossil fuel to renewable energy. They have to do that transformation because if they don't, they won't be around once oil starts to not be used as much. And I think it's surprising how quickly we're transforming our energy system from fossil fuels to renewables. There are many weeks in the UK now where we've had record amounts of renewable energy driving the UK's power supply. So, for example, when it's been very windy, we've had a lot of wind generated power, and we just haven't needed much fossil fuels to kind of make up our demand, to satisfy our demand for power. And I think that's true in many countries now. I think it's surprising how quickly we're transitioning to electric cars, for example. It used to be the case that if I saw a Tesla on the road, it was unusual, but now I see them all the time. And I'm sure that's true where you live as well. So I think energy companies are undergoing this transition. The difficulty is that it's going to be very expensive to do that transition, to switch from fossil fuels to actually being a distributor of energy for cars, usually via their existing network of energy distribution. So gas stations in America, petrol stations in the UK and elsewhere could be used to provide power points for cars. And it's natural for us to do our charging in those places. So I think they have an advantage from that point of view because they've got the distribution networks and we associate them with filling up our cars. So I think it's going to be expensive, but my point, which I'm getting to, is I think the energy sector shouldn't be counted out because it is a sector that's under transition, under a system, a kind of process of transformation that will be expensive and margins will suffer during the transition. But certainly over the long term, I think that could be an interesting investment. And just like the tobacco sector, you could have said that was finished 20 years ago. But in fact, it's been very profitable for much of that time. So, I wouldn't rule out energy investments and I wouldn't rule out the energy sector. What I'd be looking for are the companies which are doing that transformation, A, most cost effectively, B, most quickly, because I suspect we may be surprised how quickly the transformation happens, and C, most profitably. Which ones are kind of winning that Hearts and Minds campaign, which is convincing people that they are no longer a dirty, polluting company, but a future green energy company. I think that'll be the difficult thing. It'll be the PR job, convincing people that Exxon is actually caring about the environment, because obviously their track record isn't consistent with that. So I think that's the kind of way I'd look at it. But would I be investing in the energy sector right now? I think it's got a bit further to go tactically over the next 6 months or so, because energy prices are rising. There'll be a lagged effect on their revenue. And they were pretty beaten up when oil prices were zero a year ago. But yeah, I think that could still be tactically interesting. But over the longer term, I'd be cautious about the cost of the transformation. That's probably what I'd say.
Like and share.
Yes. Thank you, Laura. I've got to remind you to like our video because that helps us a lot. It's very easy for you. Just do the thumbs up on the video. And please do share because other people will find out about what we do. And we're actually aiming for 100,000 subscribers. We're still at 93,000, almost 94,000. So we've got 6,000 to go. We were hoping it would be before Laura's birthday on July the 13th. So she could have a party, and we could have a party which would be combined 100k and Laura's birthday. Yeah. But sadly, that doesn't look likely. But still, it'll be nice if we do get to 100,000 sooner rather than later. But, I'm in it for the long haul, and it's not just about numbers. But yes, please do subscribe if you're not subscribed, and then you can be notified when we publish a video. And we put a huge amount of work into the videos to try and keep them interesting. So please do subscribe. And please feedback, tell us what you think about what we do. We certainly read almost all of the comments that we get and all of the spam, all those naughty spammers. But yeah, please do share, like and subscribe, even if you're watching the in replay, because that helps us. There's a super chat from Leonard von Nebelschutz. Thank you very much, Leonard. Nice to hear from you again in Holland. And Leonard has a question, which is he has an idea to reallocate from 85% VGWL to WSML, IWVL, okay, each 10% and 45% VGWL. What do you think? Oh, and 5% crypto. Okay, well, I think it's going to be difficult for me to comment on that portfolio because I'm not familiar with all the tickers for starters. So let's have a look at VGWL. And I'll share my screen so other people can see this. Let me just fire up the tickers first, and then we'll take a look. And then 45% VGWL. Okay, here we go. So VGWL is the Vanguard FTSE All World UCITS ETF, and I think he's just giving us the composition of that global ETF. So he's going to reduce his VGWL allocation, is what I think he's saying. Okay, well, what are you going to put it into, Leonard? That's my question. But if I look at that so let me just show you what Leonard's got, and then you can see how I'd read this. So let me just share my screen, and then you'll be able to see. Okay. Let me just put myself in the bottom corner here. So this is the fund that Leonard is talking about. Now, I did a video on global equity funds recently because I think this is a great core for your portfolio because firstly, these things are generally very cheap. So what's the fee on this one? The fee for this one is, can we see it? Ongoing charge, 0.22. So the fee on this one is pretty low, 0.22. And you can literally buy the entire global equity market, which is what this FTSE Russell All World Index tracks. So emerging markets, developed markets, all in one fund. So as the core of your portfolio, it's diversified. It gives you that global equity exposure. It will give you, say, roughly 5 or 6% return above inflation if the future resembles the past. So over the past 120 years, that's roughly what global equity has given. So if the future resembles the past, that's what you'd expect. So that's a reasonable core of your portfolio. It rebalances automatically, so you don't have to rebalance, and the fee is low. So it ticks a lot of boxes, but it looks like what Leonard is going to do is reduce his exposure to that from 85% to 45%. And he's going to add a little bit of crypto. Well, the time to buy crypto is when the price has fallen sharply, which is now. So it has fallen by over 50%. I know that because I bought at the top. I should have warned people because that was the sign of a market top when I bought. But I think that that's a reasonable allocation. But my question would be, I guess, what are you going to put it into? What is it going to be that you move into?
I did that on the bottom.
Oh, did you?
Yeah.
Okay.
Just need to refresh, maybe.
So, allocating more into small cap and value, allocating to emerging markets. Okay, so that looks like you're kind of tilting into things which are more tactical. Yeah, I mean, small cap value is something which historically has done very well, and recently not so well over the last 5 years or so, or longer. So maybe small cap value is going to make a comeback, yeah, but you're taking a gamble there. But still, if that's your belief, then yeah, why not? and emerging markets, more to emerging markets. That is what other fund managers are doing, for example, at the moment. So I recently did a video where I talked about how the US may have difficulty scaling because of its mega caps saturating their respective markets, whereas China can probably scale its businesses much more effectively and much more quickly. So in relative terms, China might be better in terms of growth than the US as a result of that. I mean, it's not my view. This is the view of the Scottish Mortgage Investment Trust, which is a UK investment trust, which is like Cathy Wood's ARC fund. It's the UK equivalent. But they are tilting away from North America to China and also towards Chinese tech companies, particularly the disruptive ones, because they think that's where it'll scale more in terms of growth. So, yeah, I mean, I think that tilt to emerging markets is more risky. Just be aware of that. If global equity markets fall, emerging markets usually fall more. But I know you, Leonard, so I know that you would just buy more. So that's probably okay. Small cap value is more of a brave decision, I think, given what's happened over the last 5 years. But, you know, a bit of bravery might pay off. So I don't think that's unreasonable. And it's certainly not a hugely risky portfolio. If you'd put a huge amount into a single stock or something more risky, something that was levered, then I'd definitely be much more concerned. But if global equity markets rise, that portfolio will rise with it. If anything, it'll rise more. So, yeah, I think that's a very sensible portfolio. Exactly as I'd expect, Leonard. Well done. So, next question from Shivam Singh, who's done a super chat. Thank you, Shivam. I appreciate that. What's the biggest holding in your portfolio as of now? I think, just from memory, the equity part, I've only got like 4 installments. So that'll be probably about 10% of my portfolio will be global equity. And it's a global equity fund. It's not very exciting. And then the rest, I've got about, I'd say about 10% in a long duration UK gilt fund and about 10% in a US treasury fund, but that one's sterling hedged, just in case sterling strengthens versus the dollar. So that's my allocation, and the rest is in cash. So I'm very, very low risk at the moment. And so what I'm doing is I'm buying equity with my cash because I don't want to sell my bonds, because those are the things which will go up in value if equity falls sharply. Then if there is a sharp fall in equity and a large fall in equity, I expect the bonds will rally. I'll use the bonds to buy equity, and I may use a lot of my cash as well to buy equity, depending on how large the fall is. A huge fall, I might go all in, you know. And then I've also got a shopping list of things which I'd go for if equity markets crash. Things which are currently too expensive, but which I'd definitely buy at a lower price. Things like high yield credit, things like emerging market sovereign debt, particular thematic ETFs. I might go for something growthy like Scottish Mortgage, for example, which I still think is too expensive. That's the kind of thing I'd go for. So more high risk stuff. That's on my shopping list. So at the moment, very cautious, but I'm standing ready to change that if the situation demands it. But certainly at the moment, very cautious. Lenin says, have you heard of Crypto 20? What's your view? I haven't heard of Crypto 20, but it's interesting. I often ask on the Patreon group. So we have a crypto channel now on Slack, where the people in the pension crafters who've been investing in crypto for a long time, they're effectively teaching me about investing in crypto. So I'll ask about Crypto 20 on there. But I haven't come across it. But I'm not aware of it, so I can't really comment on it. But certainly I'll have a look and Yeah, I will have a look. There was an interesting thread actually recently on Slack in our crypto channel, talking about yield and how to generate yield on things like USDC, which are tokens which are linked to the value of the dollar. Very low volatility, so it's not like Bitcoin and Ethereum where the volatility is 80%. The volatility on these safe tokens, which are linked to the value of the dollar, is very low. It's just like cash. It's almost zero. And yet you can earn about 16% yield on that, which always makes me suspicious, because whenever I see a yield of, say, 16%, there's got to be risk in there. So I'm just trying to work out what the risk is at the moment before I put any money into it. But we were talking about which platforms are actually good for that kind of yield farming, as it's called. And there were interesting divisions of opinion about which platforms were good. So BlockFi, somebody said it's a scam. Other people said it's completely safe. So, it's really hard to tell with these platforms, given that none of them are regulated fully. It's very hard to tell which ones are the kind of safe ones. Is Nexo safe, for example? So anyway, I think I probably will put some money into those just to find out how they work. I usually put my money at risk so that I can learn as well as generate returns. So yeah, anyway, the crypto channel, I'll ask them about that very question. So thank you for asking. But I'm sorry, I don't have an answer for you. So let's go back to the questions. And next question, Andrew O'Connell. Nice to hear from you, Andrew. Thank you for supporting us. How do experienced investors deal with FOMO? Every day you hear of one sector or another being the next big thing. Financials, energy, value, growth. Well, I think the thing to understand is, if you are an experienced investor, it doesn't stop you from being tempted. But I think the benefit of having lost money with fads is that you realize what your limitations are. Hopefully you learn that, right? And the difficulty actually is, if you're a successful investor, you assume that your success is due to your skill. So success is a terrible teacher. So I think if you have been successful in the past, that's one risk. You think, I'm a genius, I can't go wrong, and that's when things usually go badly wrong. But if you're more humble about it and kind of admit when you've been lucky, because luck, it generates a lot of return. And I think people who are experienced, who are good investors, admit that in many cases it is luck. I think the way to avoid that is to kind of scratch the itch a little bit by do allocate small amounts to these thematic investments. And then when you lose money, if you do lose money, which you probably will, then it doesn't really matter. So for example, my crypto investment wasn't a lot of money. It's a very small proportion of my full investments. So if I lose half of it, I don't really mind. It's not a disaster. And I was kind of expecting that anyway, given the volatility. But if I'd put half of my portfolio into it, that would have been very different. So say 5% or less of your portfolio, set that aside for play money to allow you to scratch the itch. And then with the remaining 95%, you can be more sensible. So just think of that as your sensible bucket. And then 5% is play money, where you can buy Tesla call options or whatever you want, levered soybean futures, whatever it is you want to do, because then it doesn't matter. If you're right, it's good. If you're wrong, it doesn't matter. But in terms of working around your own flaws, I think self-knowledge is also very important. Understand your own psychology, because what works for me will not work for you. And that's why I always try to say, you have to find your own path. And I don't try and force a path onto people in PensionCraft, for example. I try to lay out the facts, the statistics about what works in the past, what doesn't. And then people have to find their own method, their own portfolios, which work with their psychology, how risk averse they are, how much they like to take a gamble, how engaged they want to be with their investments, because some people buy single stocks for that very reason. And that's different for everyone. So that's why I think you've got to find your own path. And I think that's what experienced investors do. They find workarounds around their own cognitive biases which work. So Jim O'Shaughnessy, for example, only does quantitative investing, where there are basically rules which govern what his portfolio is invested in. And he's gone for US micro caps. And he's found patterns in the past which work very well. And he's just stuck with that for years. And he's probably done very well out of it. But, you know, everyone's got to find their own path. So that's why I think when you hear what Warren Buffett's doing, who cares? I mean, you're not Warren Buffett. I'm not Warren Buffett. We have to find our own way. And just pay attention to facts, you know, make it evidence-based. Don't take too much risk, diversify, keep your fees low. It's all the kind of boring stuff which works. And then play around with a little bit of your portfolio is what I'd say. Okay. Yes. Please like our stream and also subscribe if you're not subscribed. That'll push us closer to 100,000. And yeah, so the other thing you can do is to support us on YouTube. And if you do, actually doing this call, then you'll get to be pushed to the front of the queue if you have a question. So Teddy's just powering up because he's got treats. He likes YouTube lives because he gets treats. Oh, he's very good. Bit more? Go on. Yes, good boy. Right. Next question is Andrew O'Connell, who says, thank you for supporting us, Andrew. Oh, I've done that one. Yeah. So the next one is Jack Lemasson, who says, hi, what's your opinion on the future value of the US dollar with all this money printing? And can it lose its global reserve currency position eventually? Yeah, I mean, this one crops up a lot because what usually happens is somebody watches a video by Ray Dalio and then they look at his book and it's got, you know, like 4 centuries, 5 centuries showing that the reserve currency in the past has changed, you know, roughly every 100 years or so, I think. And, you know, it used to be sterling, now it's the dollar. And the idea is that because of all this money printing, the US is not going to be able to meet its liabilities and the dollar is going to massively devalue. And of course, if that happened, the entire financial system would go through a very large discontinuity. There'd be a big sell-off in equity. There's no doubt if that happened. And but I think there are a couple of problems with it at the moment. So firstly, if you look at which currencies is second most popular, and there's a nice paper by Geeta Gopinath, who's the chief economist for the IMF, talking about the dollar and whether it'll lose its reserve status. The second most popular currency for trade deals, for trade, is the euro. So the question is, and then third most, is a long way behind the euro, third most used currency. So the question is, do you think the euro will replace the dollar as the currency, the reserve currency? I think that's very unlikely. Will it be the renminbi? I doubt it, because that's even more infrequently used, even less popular than the euro, much less popular, in fact. So I think it's unlikely that the dollar is going to lose its supremacy probably over my lifetime, which will be a while. Yeah, I hope. So maybe, next 20 years, 30 years, I'm not expecting that the US dollar is going to be replaced. In terms of meeting liabilities, you can actually look at the US Treasury. So the US Treasury publishes a weekly report on its expenditures. US Treasury Fiscal Service Weekly Report, I think it's called. Here we go. So let me share this with you just so that you can do this yourself, because I always think it's good for people not to take things at face value and just dig into it themselves. So this is what I'm talking about. Now they have a weekly statement. Where is the weekly statement? Monthly, daily. Yeah, let's do the monthly. And it's a really nice document. It's really clear. So whoever writes it, thank you. It's very clear. This is the one for May. And they just lay out all of the things which the US government spends money on. And they itemize it. So you can kind of drill into it and just see, you know, what it is that they're spending their money on. So if you're a US taxpayer, they've got all of this transparency. So this is the money coming in by source. So you can see a lot of it comes from people's taxes. Very little comes from companies. So companies in America fund almost none of US spending. The vast majority of taxes come from individuals. And that's a choice made by the US government. And US citizens seem to be happy with it. Otherwise, they would have done something about it, I guess. And then the outlays, this is the breakdown of the outlays. General government is the big chunk. Income security, which is, I guess, social security, and at the moment also helping people during the pandemic. Healthcare for people who can't afford it. Commerce and housing credit, and so on. National defence is obviously a big chunk. Now, a very small slice of it is net interest. Now, that's the interest which they're paying on US debt at the moment. And there's a nice picture down here which shows you that again in a bit more granularity, I think. So here's the histogram month by month of that expenditure. And the part of it which is the net interest is this kind of azure cyan color, which is here. So just see how tiny it is. Now remember that the US debt is very large, but in terms of the cost of servicing the debt, if interest rates were to double, it would still be much smaller than, say, spending on health. In fact, if it was to quadruple, it would be roughly the same size as the health spending. If interest rates were to quadruple from where we are now. So if interest rates went to 8% for the 2-year treasury, for the 10-year treasury, that would still be affordable. So I think saying that the US will not be able to meet its monthly expenditure is simply incorrect. So what I'd say is just look at the data, yeah, and make it factual. And in order to be sustainable, the debt has to grow by less than GDP. Now, that is the case in the US at the moment. So as long as growth, GDP growth, is higher than the debt growth every month, then it's not a problem because the debt to GDP ratio will go down. And that's how people have grown out of huge debt piles in the past, after the Second World War, after the War of Independence against the UK, against England at the time. The US took on a huge amount of debt during that the revolution against England, but it kind of grew out of it because GDP grew very quickly after that War of Independence. So I think it's just silly to say that we're going to have huge devaluation of the dollar because of the money printing. You know, where's the evidence for it? The dollar has actually strengthened quite a lot recently, so I don't buy the argument that the dollar is going to suddenly weaken and the money printing is going to be negative. And it takes a long time for these kind of transitions of reserve currency status to happen. And it's usually a massive triggering event like a world war or a revolution or, you know, something cataclysmic. And the pandemic didn't even touch the dollar in terms of its supremacy. So what would it take to do that? Something pretty big. So I don't buy it. And secondly, I don't like it when Ray Dalio says that, because I get all of the worried people coming to talk to me saying I've changed my portfolio because I think the dollar is going to massively devalue. There are much more likely outcomes, which the most important one of which is that doesn't happen. Just think how likely is it to happen over your investment horizon, and then think about the allocation. So you've always got to use that probability when you invest. If you're always worried about tail events like the dollar devaluing massively or a global meltdown in equity markets, then you'd never invest and your outcome will be very poor because you'll be too cautious. So don't allocate for tail events, allocate for the most likely outcome is what I'd say. And I think that outcome is very unlikely for the dollar to devalue massively. So, but you know, keep an eye on it, obviously, because it could happen, but don't change your portfolio for these crazy tail events, which are being drummed up by people, perhaps for their own reasons, to kind of drum up that fear. Okay, next question. Super chat from Chestad. Thank you, Chestad. Do you have an opinion on covered call ETFs regarding risk? There's a fair number of them in the USA. Some based on QQQ, others on the S&P 500. So if you're not familiar with them, the covered call ETFs are a way of increasing the dividend yield on a boring index. So let's say you've got the S&P 500 where the dividend yield is, I don't know, maybe 1 or 2%. How about having the S&P 500 with a yield of 7%, or NASDAQ with a yield of 10%. Wouldn't that be great? Well, yeah. But the question should always be, when you hear something like that, what am I giving up? So what you're actually doing, or what the fund manager's doing, is selling the upside in the form of a call option. So at any point in time, if, say, the NASDAQ rises by 10%, you've sold the upside above 10%. So if it rallies beyond 10% and you hold that fund, you won't get the upside. The upside is capped at 10% over some period of time, which is the maturity of the call option. So if the rally is very strong, you'll miss out. That's the price you're paying. And the more volatile the equity market is, the more the fluctuations are moving the index up and down, the more the price of the option goes up. And when you sell the option, you monetize a bigger premium. And so for a very volatile index, you get a bigger upside, you get a bigger income generated when you sell the upside. So volatile stocks, volatile indices will have a bigger boost to their income from this strategy of selling the upside than a low volatility index like the S&P. So for the NASDAQ, you can get kind of crazy yields. So let's have a quick look at this one. I think we talked about this one before, actually. And it was on a YouTube Live, I think. So this one is... Yeah, here we go. This is the Global X one. So let me just share my screen so you can see this. Oh, no. There we go. And there we go. And if we go back to this is the QYLD ETF. This is not a recommendation, by the way. Just make sure I'm sharing my screen. I am. So this thing, have a look at the yield on this thing. The yield is 12.54%. Incredible, right? So you can buy the NASDAQ, the ticker for which, the biggest fund which tracks the NASDAQ is called QQQ. So this one is called QYLD because it's high yield. And what this thing is doing is it's writing this option, selling the upside of the NASDAQ. And when it runs out, when the option matures, when it expires, a new option is sold. So you're always selling the upside from where you are now. And this thing is going to underperform when equity markets rally strongly. So in a strong equity market rally like we saw at the end of last year, the beginning of this year, this thing will massively underperform. But while it doesn't underperform, and if equity markets are trading sideways but are volatile, which they kind of are now, then this thing will pay out big time because it's giving you that 12% income selling the upside that doesn't happen. So that's the way these things work. Now the fee is fairly high for this one, I think. Where's the ongoing fee? 0.6%. So anything above about 0.2 is expensive. So that one's pretty expensive. But certainly for an index which is very volatile, these things are great. So if we look at the value of this thing, QILD, on Coifin, which is great. QILD. Here we go. And if we just look at the price, get rid of these silly momentum indicators and the entire history. Notice how during this rally period, after the big sell-off in March last year, this thing didn't rise as much as the NASDAQ. The NASDAQ rose much more because the cap on this thing was fairly severe because of selling the upside. But now, notice that in the last few months, the NASDAQ's been trading sideways. So if we zoom in just on that region, now that the NASDAQ is kind of trading sideways, but a very volatile sideways movement, it's monetizing all that volatility and turning it into yield. So if you do think markets are going to trade sideways or even fall a little bit, this is a way of buying an index you like, but getting a high yield. So I think that's really interesting. I mean, I like it. Yeah, I like it. So back to me and back to the question. And I think there was a second part to the question, actually. Yeah, in terms of risk, if you actually look at the volatility of those funds, the volatility is lower. That's because they've sold the upside, and that reduces the volatility of the index. So what are the risks? The only risk really is that you get a very strong rally and you miss out. That is the risk with those funds. But in terms of counterparty risk, the risk with the derivative is limited because you've already sold the derivative. You could get assigned on the call option, but that's normal market mechanics. So I don't think there's a huge risk that's embedded in those strategies. Strategies which involve leverage are risky, but selling an option, as long as you own the underlying, is not risky. It actually reduces the risk. So I kind of like those, I have to say, particularly in these markets, which do seem to be range bound and no longer strongly rising.
3 more questions.
Oh yeah. So, as Laura says, 3 more questions and then we're done because it's now 7:54, and I think we've got 3 member questions, so 3 supporter questions on YouTube. So please like our stream, even if you're watching the replay, subscribe, and consider supporting us on YouTube because that way we can stay independent and carry on doing what we're doing. First question from Richard Gordon, who says, would you hedge your assets in this market? There are many types of hedge. I mean, I could do an interest rate hedge, currency hedge, equity hedge. I guess what you're talking about, Richard, is an equity hedge. And the difficulty with an equity hedge, I mean, I've got an equity hedge, which is my treasury holding and my UK gilt holding. So I do hedge my assets in that sense. And I am hedging at the moment. So yes, I am hedging. But I'm working up to hedging very little. So my end point after 24 months of drip feeding will be 80% equity in a global equity tracker. And I'll have 2 other funds, which are my UK gilts and US treasuries, sterling hedged. I am hedging my US Treasuries because I am concerned that sterling will rally very strongly and reduce the value of my Treasuries. Sterling's been fairly choppy recently, so I don't want that risk, and I think it is a risk. I wouldn't do it for an equity fund because equity is much more volatile than Treasuries, so usually not worth hedging, because the volatility of equity is roughly twice that of developed market currencies. So I probably wouldn't hedge the kind of FX, the currency, but I would hedge the equity risk, because I do think we are at very high valuations. There's a lack of momentum at the moment, but I'm still averaging into the market because my research has shown me that holding back your money when valuations are high is generally not a good idea. Valuations stay high for a long period of time. But hey, when I buy equity, that's usually a sign that we're at the market top. So read into that what you will. Stephen J says, what do you think about the Farmer and French 3 or 5 factor models? Do you think it will outperform growth in the long run, 30 to 50 years, even if the zero interest rate environment continues? Well, I guess what you're saying is the factor funds, which track some of the Farmer and French factors, are they going to outperform broad markets in the long run? Now I started off this kind of hour by saying everybody's got to find their own way of investing to overcome their own cognitive biases. And my difficulty with factor investing is you get long periods when these things underperform. So let me just show you quickly what I mean by that. If I just share my screen and go back to Koifin, there's a nice market dashboard which talks about factor analysis. Now, if I look over the last 5 years, what it does here is it shows you how each of these different factors has performed. So if we look at large cap value, notice how over the last 5 years it's underperformed by 20%. And if we look at small cap value, it's underperformed by 14.9%. Now let's look over 10 years, and you can see that over that period, small cap values underperformed by 28%. Now recently, if we look over the last 3 months, say, small cap value is finally making a comeback. So you could say that this is the chance for this factor to come back. But for the poor people who've been long small cap value over the last decade, they've massively underperformed. That's the purple line here at the bottom. So imagine how difficult it would be to stick with that for a decade when everybody else is talking about how large cap tech is doing so well, Microsoft, Google, Apple. You have to deal with all of those headlines, and you'd have to stick with that strategy. So I think the cognitive difficulties with sticking with one of these factor funds are huge, because it will underperform for long periods of time. So even though over 60 years, historically it's always outperformed, there are long periods when it won't. And I think for many people, for me, it would be too difficult to stick with it through those periods. Whereas if I have global equity, well, I've kind of got exposure to everything. So I'll participate in the rallies usually. I won't get the full benefit of every theme which does well, but at least I'll have part of it. So I think that's my difficulty with factor investing. You've got to choose a factor, stick with it for a long period of time, because that, the back tests show that that's what you need to do for it to work. And I think for many people that's too difficult. Last question is from Terry Dunning. Thank you, Richard. Thank you, Stephen. Thank you, Terry, for supporting us. We really appreciate it. Would you be worried about the massive leverage in the market? Yeah, if you look at the amount of leverage at the moment, there are pockets of leverage. a lot of leverage at brokers. So yes, that's worrying, because if people have a large levered position, and many of them are new entrants to the market who saw the incredible rally we had at the end of 2020, the beginning of 2021, where you just couldn't lose money on these, stonks. That's not the way it usually happens. And if you are levered and there's a sharp fall in the markets, then it multiplies your loss and you could be completely wiped out. And I'm reminded about the third partner that worked with Warren Buffett and Charlie Munger, who nobody's heard of, because he had a very large levered position. And then there was a very sharp fall in equity markets in 72, 73. And he was forced to sell his Berkshire Hathaway shares to Warren Buffett for something like $40 each. And of course, now they're worth thousands each, $20,000. So there's a reason why you didn't hear about him, because he did that kind of leverage trade. So I'd say I would be worried about people who've got leverage positions. I'd also worry about the amount of leverage in the market. Yes, I would, because that tends to amplify market movements, because when markets fall, these people will get margin called and, they may have to sell as markets fall, and that kind of amplifies the market loss. So that is a worry. And I wouldn't be taking too much leverage in the market, or ever actually. I mean, it's not a good idea generally. So yeah, that is a worry. And hopefully the amount of leverage will reduce over time. But I realise we're coming to the end of our hour. So let me wrap it up there. Thank you all for asking such great questions again. I'm always amazed by the quality of the questions. So thank you. And please do subscribe. Please do like. Please do share this with other people, and we hope we've been helpful. We try to keep our content interesting and helpful. We get a lot of positive feedback, so I assume we're doing something right, and we are very close to 100k subscribers, which we're very excited about. So have a great 2 weeks, everyone, and we'll see you in 2 weeks' time. So have your questions ready. Bye-bye.